Hello, everyone. Welcome to another episode, and we've got breaking news from the precious metals market that has everyone talking. We are witnessing what could be the most explosive day in silver and gold trading this year. Right now, as I'm recording this, a staggering $14 billion emergency sale is sending shockwaves through the entire precious metals sector. Traders are scrambling, prices are volatile, and if you own gold or silver, or have been thinking about buying, the next few minutes could change everything for your portfolio. This isn't your typical market fluctuation. Something big is happening behind the scenes, and the timing? Incredibly suspicious. Major institutions are making massive moves, and retail investors are being left in the dark. Is this a coordinated dump, a strategic buying opportunity, or the beginning of something far more serious? The implications are massive. We're talking about potential price swings that could either devastate unprepared investors or create the buying opportunity of the decade. Silver especially is showing patterns we haven't seen since the last major market disruption, and if history repeats itself, the next 48 hours could be absolutely critical. I've got the charts, the data, and the insider perspective that mainstream media won't show you. This could be your warning signal or your golden ticket, but you need to understand what's really happening right now. If you're serious about protecting your wealth and capitalizing on this chaos, smash that like button and let me break down exactly what this 14 billion move means for you. So let me start by saying, this is not a drill, and this is not another one of those clickbait situations where we overhype a minor market movement. What we're seeing today in the precious metals market is genuinely unprecedented in recent history, and I need you to understand the gravity of what's unfolding right before our eyes. This $14 billion emergency sale that is rocking the gold and silver markets is not just a number on a screen. It represents a fundamental shift in how major institutional players are positioning themselves, and more importantly, it tells us something critical about what these power players know that the average investor doesn't. Now, before we dive deep into the mechanics of what's happening, I want you to understand something crucial. The precious metals market, particularly silver and gold, operates very differently from stocks or cryptocurrencies. These markets have been around for thousands of years, and they've always been the ultimate safe haven during times of economic uncertainty. When governments print money recklessly, when inflation spirals out of control, when banking systems teeter on the edge of collapse, people flee to gold and silver. It's been this way since ancient Rome, and it continues to be this way today. But here's where things get interesting and frankly, quite alarming. When you see massive institutional players dumping $14 billion worth of these assets in what appears to be a coordinated emergency sale, you have to ask yourself what they know that we don't. Let me walk you through exactly what happened over the past 24 hours, because the timeline here is absolutely critical to understanding the bigger picture. Early yesterday evening, several major financial institutions began offloading massive positions in both gold and silver futures contracts. Now, for those of you who might not be familiar with futures contracts, let me explain this in simple terms. A futures contract is essentially a bet on where the price of an asset will be at a specific point in the future. These contracts allow traders to control massive amounts of gold or silver without actually having to own the physical metal. It's a way for institutions to leverage their positions and multiply their gains, but it also multiplies their losses when things go wrong. What we witnessed starting late yesterday was an absolutely unprecedented wave of selling in these futures markets. We're talking about trading volumes that exceeded normal daily activity by more than 300% in some cases. Silver futures in particular saw a level of selling pressure that veteran traders are saying they haven't witnessed since the financial crisis of 2008. Think about that for a moment. We're seeing selling activity comparable to one of the worst financial disasters in modern history. And yet, mainstream media is barely covering this story. That alone should tell you something is deeply wrong with the narrative being fed to the public. The selling didn't just impact futures markets either. We saw significant movement in the physical bullion market as well, with major dealers reporting unusually large transactions from institutional buyers who were liquidating positions. Now here's where it gets really interesting and honestly quite concerning. When you look at the pattern of these sales, they don't appear to be profit-taking from investors who made gains and decided to cash out. The pricing and timing suggest something much more urgent, almost desperate. These are the kinds of sales you see when institutions need to raise cash immediately when they're facing margin calls or when they know something catastrophic is coming and they need to reposition their entire portfolio before the hammer drops. Let us talk about what this means for silver specifically, because silver is behaving in ways that are absolutely fascinating from a technical analysis perspective. Silver has always been the more volatile cousin of gold. It's used extensively in industrial applications, everything from solar panels to electronics to medical equipment. This dual nature of silver as both a precious metal and an industrial commodity makes it incredibly sensitive to economic conditions. When economies are booming and manufacturing is strong, silver prices tend to rise because of increased industrial demand. When economies are struggling, silver often serves as a safe haven asset like gold. But what we're seeing right now is something different entirely. The silver market has been in a state of structural deficit for several years now, meaning that global demand for silver exceeds the amount being mined from the earth. This is a critical point that many investors overlook. Unlike gold, which is primarily held as a store of value and rarely consumed, silver is actually used up in industrial processes. Once it's integrated into a solar panel or an electronic circuit board, it's extremely expensive and often impossible to recover and recycle. This means that over time, above ground, silver inventories have been steadily declining even as demand continues to climb. We've reached a point where the silver market is tighter than it's been in decades, with some estimates suggesting that available silver inventories could be exhausted within the next few years if current trends continue. Given this backdrop of structural deficit and rising demand, you would expect silver prices to be climbing steadily or at least remaining stable. Instead, what we witnessed yesterday was a sharp decline in prices as this massive selling pressure hit the market. This is what traders call a disconnect between fundamentals and price action. And it's often a sign that something unusual is happening behind the scenes. When markets don't behave according to basic supply and demand principles, it usually means that powerful forces are at work, forces that have the ability to temporarily override natural market dynamics. Now, I want to address something that I know many of you are thinking right now. Could this be manipulation? Is this another case of big banks and financial institutions artificially suppressing precious metals prices to protect their positions or to benefit some larger agenda? Look, I'm not one to jump to conspiracy theories without evidence, but the precious metals market has a well-documented history of manipulation. We've seen major banks pay billions of dollars in fines for spoofing and manipulating gold and silver prices. This isn't speculation or conspiracy theory. These are proven facts with legal judgments and settlements to back them up. So when we see price action that doesn't make sense given the underlying fundamentals, it's completely reasonable to question whether manipulation might be occurring. But here's what I think is actually happening. And this is where things get really concerning for anyone who cares about their financial future. I believe what we're witnessing is not so much manipulation as it is preparation. These major institutions aren't suppressing prices for the sake of suppression. They're creating an opportunity to reposition themselves before something significant happens in the broader economy. Think about it logically. If you were running a major financial institution and you had insider knowledge or sophisticated analysis suggesting that a major economic event was imminent, what would you do? You would quietly start adjusting your positions to protect yourself and position for profit when that event occurs. The challenge with precious metals, particularly for large institutions, is that these markets are relatively small compared to stock or bond markets. When you try to buy or sell huge positions, you move the market against yourself. If you try to buy $1 billion worth of silver, your buying pressure pushes prices up before you can complete your purchase, meaning you end up paying more for each subsequent ounce. Conversely, if you try to sell $1 billion worth, your selling pressure drives prices down. So what do sophisticated institutions do? They create temporary dislocations in the market through coordinated selling, driving prices down artificially, and then they quietly accumulate at these suppressed levels while retail investors panic and sell. Let me share with you some specific data points that support this theory because I don't want you to just take my word for it. Over the past 6 months, we've seen an interesting divergence between reported institutional holdings of precious metals and the price action in these markets. While prices have remained relatively flat or declined slightly, physical demand for gold and silver from central banks, particularly in countries like China, India, and Russia, has been absolutely voracious. China alone has been adding to its gold reserves every single month for over a year, accumulating thousands of tons of gold while publicly remaining fairly quiet about their strategy. Why would they do this? Because they understand that gold and silver represent real money, real stores of value that cannot be printed into oblivion by central banks. Speaking of central banks, let's talk about the elephant in the room that nobody in mainstream media wants to discuss honestly. Global central banks have been on an unprecedented money printing spree for over a decade now, but it accelerated dramatically in response to the pandemic and subsequent economic challenges. The Federal Reserve, the European Central Bank, the Bank of Japan, and virtually every major central bank has expanded their balance sheets to levels that would have been unimaginable 20 years ago. They've created trillions upon trillions of dollars, euros, yen, and other currencies out of thin air, flooding the global financial system with liquidity in an attempt to prevent economic collapse. Now, in the short term, this money printing can create an illusion of prosperity. Asset prices go up, stock markets reach new highs, real estate becomes more expensive, and everyone feels wealthier on paper. But there's a fundamental problem with this approach that anyone who understands basic economics can see. When you increase the supply of something without increasing its underlying value or utility, you decrease its purchasing power. This is basic supply and demand applied to currency itself. Every dollar, euro, or yen that gets created out of thin air dilutes the value of every existing unit of that currency. This is inflation in its purest form, not the consumer price index that governments report, but real monetary inflation. Gold and silver have historically been the ultimate hedge against this kind of monetary debasement. You cannot print gold, you cannot create silver out of thin air through accounting tricks. These metals exist in finite quantities on Earth, and extracting them requires real work, real energy, and real resources. This is why throughout human history, whenever fiat currencies have failed, and they always eventually fail, people return to gold and silver as money. It's happened in ancient Rome, in revolutionary France, in Weimar Germany, in Zimbabwe, in Venezuela, and countless other examples throughout history. The pattern is always the same. Governments print too much money, currency loses value, people flee to hard assets, and those who position themselves correctly preserve their wealth, while everyone else sees their purchasing power evaporate. So when we see a $14 billion emergency sale in the precious metals market, we have to consider this within the broader context of what's happening in the global economy. Are we approaching another major financial crisis? Are central banks losing control of inflation? Are we heading toward a currency crisis that will make previous crises look tame by comparison? These are not idle questions or fear-mongering. These are legitimate concerns based on observable economic data and historical patterns. Let me give you some specific indicators that suggest we might be approaching a major turning point in the global economy. First, look at the bond market. Bond yields have been incredibly volatile over the past year, with the yield curve inverting multiple times. For those unfamiliar with what this means, an inverted yield curve is when short-term interest rates are higher than long-term rates, and this has historically been one of the most reliable predictors of coming recessions. Every major recession in modern history has been preceded by a yield curve inversion. The bond market, which is much larger and often more sophisticated than the stock market, is essentially screaming that something is wrong with the economy. Second, look at what's happening in commercial real estate. Office buildings in major cities are sitting empty as remote work has become permanent for many companies. Shopping malls are closing, retail spaces are being abandoned, and property values are declining in markets that were previously considered rock solid. Banks hold enormous amounts of commercial real estate debt on their balance sheets, and as property values decline and loan defaults increase, these banks are facing potential losses that could dwarf what we saw in 2008. Remember, the last financial crisis was triggered by residential real estate. A commercial real estate crisis could be even worse because the loan sizes are larger and the banks are more concentrated in their exposure. Third, consumer debt levels are at all-time highs. Credit card debt, auto loans, student loans. They've all been climbing steadily while real wages, adjusted for inflation, have been stagnant or declining for most workers. People are borrowing more just to maintain their standard of living, and this is not sustainable. At some point, either through rising interest rates making debt service impossible, or through income reductions from economic slowdown, this debt bubble will pop. When it does, it will trigger a cascade of defaults that will ripple through the entire financial system. Fourth, and this is perhaps most concerning, we're seeing cracks in the banking system itself. Remember what happened earlier this year with several regional banks failing? Those weren't isolated incidents caused by poor management at a few institutions. They were symptoms of deeper structural problems in the banking system. Banks make money by borrowing short-term at low rates and lending long-term at higher rates. When interest rates rise rapidly, as they have over the past couple of years, this model breaks down. Banks find themselves holding long-term assets that have declined in value while facing higher costs for their short-term funding. This is a recipe for bank failures, and we're likely only seeing the beginning of this crisis. Now, here's where the precious metals market ties into all of this, and why this $14 billion emergency sale is so significant. Gold and silver prices are not just determined by supply and demand for jewelry or industrial use. They're fundamentally tied to confidence in the broader financial system and in fiat currencies. When confidence is high, when people believe that central banks have everything under control and that the economy is stable, precious metals tend to be overlooked. Why own gold when stocks are going up 10 or 20% per year? Why hold silver when you can earn yield in bonds or savings accounts? But when confidence starts to crack, when people begin to realize that maybe central banks don't have everything under control, when the cracks in the banking system become too obvious to ignore, that's when capital flows into precious metals. This is what happened in 2008 and 2009. Gold prices more than doubled as the financial crisis unfolded and investors sought safe havens. Silver followed suit, though with much more volatility due to its smaller market size and dual nature as both a precious metal and industrial commodity. So bringing this back to what we're witnessing today, this emergency sale of $14 billion in gold and silver positions could be interpreted in two ways, and both interpretations are honestly quite concerning. The first interpretation is that major institutions are being forced to liquidate precious metals positions to raise cash for other purposes. Perhaps to meet margin calls in other markets to shore up balance sheets ahead of expected losses, or to maintain liquidity during a period of financial stress. If this is the case, it suggests that these institutions are facing serious financial pressure, and that we might be on the cusp of another financial crisis. The second interpretation is that this selling is strategic and coordinated, designed to temporarily suppress prices so that these same institutions or their allies can accumulate physical metal at artificially low prices before the next leg up in precious metals begins. This would suggest that these institutions see significant upside potential in gold and silver and want to position themselves ahead of that move. Either way, whether this is forced selling due to financial stress or strategic selling to create buying opportunities, the implication is that we're approaching a major inflection point in the precious metals market, and quite possibly in the broader economy. Now, let's talk specifically about what this means for you as an individual investor or someone who's concerned about protecting their wealth. First and foremost, I want to emphasize that I'm not a financial advisor, and nothing I say should be construed as financial advice. You need to do your own research and make your own decisions based on your personal situation. That disclaimer aside, let me share some thoughts on how to think about this situation and what options you might consider. If you currently own physical gold and silver, meaning actual coins or bars that you possess, my strong suggestion is not to panic, and certainly don't sell into this weakness. Physical precious metals are long-term wealth insurance, not short-term trading vehicles. The whole point of owning physical gold and silver is to protect yourself against exactly the kind of economic uncertainty and financial system instability that we're seeing signs of right now. Selling your physical metals because prices dropped temporarily is like canceling your home insurance right before hurricane season. It makes no sense from a risk management perspective. For those of you who don't currently own any precious metals and have been waiting for the right time to start accumulating, well, if this emergency sale drives prices down significantly, that could present an excellent entry point. But I want to caution you about something important. There's a huge difference between paper precious metals and physical precious metals. When I talk about owning gold and silver, I'm talking about physical coins and bars that you can hold in your hand, that you store securely, and that you fully own without counterparty risk. I'm not talking about exchange-traded funds, futures contracts, or certificates that promise to give you gold or silver at some point in the future. The reason this distinction matters enormously is that in a real financial crisis, paper claims on gold and silver can become worthless or extremely difficult to convert into actual metal. We saw this during the pandemic when premiums on physical silver skyrocketed even as paper silver prices remained relatively stable. People who owned shares in silver ETFs found that they couldn't easily convert those shares into physical metal because there simply wasn't enough physical silver available to meet demand. Those who owned physical silver could sell at massive premiums or simply hold knowing they possessed real tangible wealth. This is not a theoretical concern. It's something we've witnessed happen in real time during periods of stress. Another critical point I want to make is about storage and security. If you're going to own physical precious metals, you need to think carefully about where and how you store them. Keeping everything in a bank safety deposit box might seem safe, but remember that in extreme scenarios, banks can restrict access to safety deposit boxes. And in historical currency crises, governments have actually confiscated gold from citizens. This happened in the United States in 1933 with Executive Order 6102. I'm not saying this is likely to happen again, but it's a historical precedent that exists and that you should be aware of. Many precious metals investors follow what's called the rule of thirds for storage. Keep 1/3 in secure home storage where you have immediate access, 1/3 in a private vault facility that's insured and professionally managed, and 1/3 in an offshore location outside your home country's jurisdiction. This diversified approach to storage protects you against a variety of potential risks, including theft, government confiscation, and national economic collapse. Again, these might sound like extreme scenarios, but precious metals are specifically meant to protect against extreme scenarios. If you only needed protection against normal economic conditions, you could just keep your wealth in bank accounts and stocks. Let us shift gears a bit and talk about the technical analysis side of what's happening in the precious metals market, because there are some really interesting patterns emerging that could tell us a lot about where prices are headed next. Silver in particular is at a critical technical juncture right now. We're testing major support levels that have held for months, and whether these levels hold or break will likely determine the trajectory for precious metals over the next several months. In technical analysis, support levels are price points where buying interest has historically been strong enough to prevent prices from falling further. These levels become self-fulfilling prophecies, to some extent because traders watch them closely and make decisions based on whether support holds or breaks. If silver prices break through current support levels convincingly, We could see a cascade of selling as stop-loss orders get triggered and momentum traders pile onto the downside. This could drive prices significantly lower in the short term, potentially creating an exceptional buying opportunity for long-term investors. Conversely, if support holds and we see strong buying emerge at these levels, it would send a powerful signal that demand for physical metal is robust despite the selling pressure in paper markets. This would likely trigger a sharp rebound in prices as short sellers scramble to cover their positions and momentum shifts back to the upside. The next few days are absolutely critical from a technical perspective, and I'll be watching the charts very closely to see how this plays out. One pattern that I find particularly interesting is the divergence between gold and silver prices right now. Historically, gold and silver tend to move in the same direction, though silver moves with greater volatility. However, we're seeing periods where gold shows relative strength while silver sells off more aggressively, or vice versa. These divergences often precede significant moves in one direction or the other as the metals realign their relationship. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is a key metric that many traders watch closely. When this ratio gets very high, meaning silver is very cheap relative to gold, it often signals that silver is due for a significant rally. When the ratio gets very low, meaning silver is expensive relative to gold, it often precedes a correction in silver prices. Currently, the gold to silver ratio is in an interesting middle range, not at extremes in either direction. But the volatility we're seeing could push it to one extreme or the other quickly, and that movement could create significant trading opportunities for those positioned correctly. I want to be clear though, trading precious metals, especially using leverage or derivatives, is incredibly risky and not something I recommend for most people. The volatility we're discussing can wipe out trading accounts very quickly if you're on the wrong side of a move. Physical precious metals ownership is about wealth preservation and long-term protection, not short-term speculation. Now let's address something that I know is on many of your minds, the role of cryptocurrency in all of this. Bitcoin and other cryptocurrencies have been marketed as digital gold, as alternatives to precious metals that offer similar inflation protection and portfolio diversification benefits. There's definitely some truth to this, and I think cryptocurrencies have a place in a diversified portfolio. But I want to caution against seeing crypto as a replacement for physical precious metals for several important reasons. First, cryptocurrencies are still relatively new and unproven over long time horizons. Bitcoin has only existed since 2009, and while it's performed remarkably well over that time, we simply don't know how it will behave during a true global financial crisis or a long-term economic depression. Gold and silver, on the other hand, have 5,000 years of history as money and stores of value. They've survived the collapse of countless governments, currencies, and economic systems. That's a level of historical validation that no cryptocurrency can match. Second, cryptocurrencies require functioning technology infrastructure to access and use. If the internet goes down, if power grids fail, if governments restrict access to cryptocurrency exchanges or networks, your Bitcoin holdings become difficult or impossible to access. Physical gold and silver work in any environment with or without electricity, internet, or functioning banking systems. They're the ultimate backstop when everything else fails. Third, and this is important, the crypto market is even more volatile and manipulated than precious metals markets. We've seen exchanges collapse, massive hacks, regulatory crackdowns, and price manipulation that makes the precious metals market look tame by comparison. Don't get me wrong, I think cryptocurrencies are an important innovation, and I believe they'll play an increasingly important role in the global financial system. But they're not a substitute for physical precious metals when it comes to true wealth preservation and crisis protection. A balanced approach, in my view, is to hold a core position in physical precious metals as your foundation, your crisis insurance that you hope you never need but are grateful to have if things go wrong. Then, if you have additional capital and higher risk tolerance, you can allocate some portion to cryptocurrencies, mining stocks, and other more speculative investments. But that core position in physical metal should be sacrosanct, something you build slowly over time and never touch, except in true emergencies. Let's talk about mining stocks for a moment, because this is another area where we're seeing interesting developments related to this $14 billion emergency sale. Precious metals, mining stocks, companies that actually dig gold and silver out of the ground tend to be leveraged plays on metal prices. When gold prices go up 10%, gold mining stocks might go up 20 or 30% because their profit margins expand dramatically. Conversely, when metal prices drop, mining stocks can get hammered even harder on the downside. What we're seeing right now in mining stocks is quite interesting. Despite the selling pressure in metal prices, many quality mining companies are holding up relatively well. Their stock prices haven't declined as much as you'd expect given the movement in underlying metal prices. This suggests that sophisticated investors see value in these companies at current levels and believe that metal prices will recover. Mining stocks are essentially a bet on future metal prices, and the fact that they are showing relative strength could be a very bullish signal for precious metals going forward. However, I want to caution that mining stocks are not the same as physical metals and carry different risks. Mining companies face operational challenges, political risks in the countries where they operate, management execution risk, and all the normal risks that come with owning equities. During the 2008 financial crisis, precious metals mining stocks initially sold off hard along with everything else, even though gold prices were rising. It took time for mining stocks to recover, and eventually they did extremely well, but there were periods where owning mining stocks was quite painful, even as physical metals preserved wealth. My general philosophy is that mining stocks can be a great speculation if you have a high risk tolerance and believe precious metals are entering a bull market. They can deliver outsized returns if you're right about the direction of metal prices, but they should not be confused with physical metal ownership, which serves a completely different purpose in a portfolio. Physical metals are about preservation and protection. Mining stocks are about speculation and growth. Both have their place, but they're not interchangeable. Something else I want to address is the geopolitical dimension of what's happening in precious metals markets, because this is an aspect that many commentators overlook, but that I think is absolutely crucial to understanding the bigger picture. We're living through a period of historic geopolitical realignment. The post-World War II global order with the United States and the dollar at its center is being challenged in ways that would have been unthinkable just 20 years ago. China, Russia, and increasingly other nations are working to create alternative financial systems that reduce their dependence on the US dollar and Western financial institutions. This process, often called de-dollarization, has been accelerating dramatically over the past few years. We're seeing countries settle trade in their own currencies rather than dollars. We're seeing the creation of alternative payment systems like CIPS that bypass SWIFT. And perhaps most significantly, we're seeing central banks accumulate gold at rates not seen in decades. This is not coincidental. These countries understand that in a world where the US can weaponize the dollar and the financial system, as we've seen with sanctions against Russia and other nations, you need alternatives. Gold is the ultimate alternative because it can't be frozen, sanctioned, or confiscated by foreign governments. If this trend toward de-dollarization continues and accelerates, and I believe it will, the implications for precious metals prices are staggering. The dollar's role as the global reserve currency has allowed the United States to run massive trade deficits and government budget deficits for decades without facing the consequences that other countries would face. This exorbitant privilege, as it's been called, has kept demand for dollars artificially high, which has suppressed the dollar price of gold and silver. If and when the dollar loses its reserve currency status, or even if that status is significantly diminished, we could see precious metals prices rise dramatically, simply as a result of reduced dollar demand and increased demand for alternative stores of value. This is not some far-fetched scenario. History is littered with examples of reserve currencies losing their status. The British pound sterling was the world's dominant reserve currency for over a century before being displaced by the dollar. The process took time, but once it began in earnest, it accelerated quickly. We may be in the early stages of a similar transition right now, and if that's the case, precious metals will be among the primary beneficiaries as countries and individuals seek alternatives to fiat currencies. Now, I want to circle back to the immediate situation with this $14 billion emergency sale and talk about what we might expect to see over the next days and weeks. In the short term, we're likely to see continued volatility. Large sales like this don't happen in isolation. They often trigger additional selling as other market participants react, as stop losses get triggered and as momentum traders pile on. This can create a snowball effect where prices move much further than fundamentals would justify. For those of you watching this unfold and feeling anxious about your positions or uncertain about what to do, I want to offer some perspective. Volatility is normal and healthy in markets, including precious metals markets. Yes, this particular episode seems unusually intense, but we've seen significant volatility in precious metals many times before. In 2008, gold dropped from over $1,000 an ounce to below $700 before beginning its rally to over $1,900 by 2011. Silver fell from over $20 an ounce to under $9 in 2008, before eventually climbing to nearly $50 in 2011. The point is that significant corrections and volatile price action are part of the journey with precious metals. They shake out weak hands and create opportunities for strong hands to accumulate at favorable prices. If you believe in the fundamental case for owning precious metals, and after everything I've discussed today, I hope you understand why that case is stronger than ever, then these periods of volatility should be viewed as opportunities, not crises. I also want to address the question of timing because many people get paralyzed trying to time their entry into precious metals perfectly. Should you buy now? Should you wait for prices to drop further? Should you dollar cost average over time? Here's my perspective on this. Trying to time the absolute bottom in any market is essentially impossible. You might get lucky occasionally, but you're just as likely to miss the bottom completely and end up buying at higher prices later. Or even worse, never buying at all because you're constantly waiting for better prices. A much more sound approach is to develop a systematic accumulation plan and stick to it regardless of short-term price movements. Decide what percentage of your net worth you want to allocate to precious metals based on your personal situation and risk tolerance. Then systematically build that position over time through regular purchases, perhaps monthly or quarterly. This approach, called dollar cost averaging, ensures that you buy at various price points and removes the emotional stress of trying to time the market perfectly. Sometimes you'll buy at higher prices, sometimes at lower prices, but over time, you'll build a meaningful position at a reasonable average cost. The beauty of this approach is that it's sustainable psychologically. You're not making big, all-in bets that could prove disastrous if timed poorly. You're building a position steadily over time, and if prices drop significantly, that just means your future purchases will be at better prices. This is exactly what central banks are doing, by the way. They're not trying to time the market. They're steadily accumulating month after month, regardless of short-term price fluctuations, because they understand that the long-term case for gold is what matters. Before we wrap up, I want to leave you with some final thoughts about why precious metals matter in today's world, and why episodes like this $14 billion emergency sale, while dramatic and concerning, shouldn't shake your conviction if you've done your homework and understand what you own. We're living in an era of unprecedented monetary experimentation. Never before in human history have all major currencies been pure fiat, backed by nothing but government decree and faith in the system. Never before have central banks engaged in money printing on this scale. Never before have global debt levels, both government and private, reached such extreme levels relative to GDP. This is uncharted territory, and nobody, not the Federal Reserve, not the European Central Bank, not the brightest economists in the world, truly knows how this ends. Maybe they'll thread the needle perfectly, bringing inflation under control without triggering a recession, reducing debt levels without causing defaults, and maintaining confidence in fiat currencies indefinitely. But history suggests that this kind of soft landing is extraordinarily difficult to achieve, and that monetary experiments of this magnitude usually end badly. Gold and silver are your insurance policy against these risks. They're your hedge against the possibility, I would say probability, that the current monetary system faces serious challenges in the years ahead. And the beautiful thing about precious metals is that they don't require the system to collapse for them to be valuable. They preserve purchasing power over time, regardless of what happens with paper currencies. An ounce of gold buys roughly the same amount of goods and services today that it did 50 years ago, 100 years ago, or even 1,000 years ago. Can you say the same about any paper currency? This is why I remain convinced that physical precious metals deserve a place in every portfolio, and why episodes of volatility and price weakness should be viewed as opportunities rather than reasons for panic. The fundamental case for precious metals is based on thousands of years of monetary history and basic economic principles that haven't changed despite all our modern financial engineering. As long as governments continue printing money, as long as debt levels continue rising, as long as geopolitical tensions continue escalating, and as long as the financial system remains fragile, precious metals will remain the ultimate safe haven and store of value. So as we watch this $14 billion emergency sale play out over the coming days and weeks, stay focused on the big picture. Understand that short-term price movements, while attention-grabbing, don't change the fundamental reasons for owning precious metals. Use periods of weakness to build your positions if you haven't already. And if you're already well-positioned, use them as reminders of why you made the decision to own precious metals in the first place. The system is fragile, the risks are real, and having a meaningful allocation to physical gold and silver is one of the smartest financial decisions you can make to protect yourself and your family in these uncertain times. Thank you so much for watching, and don't forget to hit that like button if you found this analysis valuable. Make sure you are subscribed with notifications turned on because we're going to be following this situation closely over the coming days, and I'll be bringing you updates as this story develops. This is a historic moment in the precious metals market, and you don't want to miss what happens next. Stay safe, stay informed, and I'll see you in the next video.